Mike Tyson, a name that once made grown men tremble, the youngest heavyweight champion in history, a beast in the ring, a global icon, and at one point, a man worth over $400 million. But in 2003, that same man declared bankruptcy, flat broke, $23 million in debt. How does that even happen? This is not just a story, this is a warning siren, a rags to riches to rubble tale. Because Mike didn't lose to an opponent in the ring, he lost to something far more dangerous, financial ignorance. You see, Tyson didn't grow up with money. He didn't grow up with wealth lessons, balance sheets, or compound interest. He grew up fighting for survival, and when money finally came, it came like a tidal wave. $400 million flowed in and it flowed out just as fast. Lavish jewelry, tigers in the backyard, multiple mansions, an entourage burning through cash like it was toilet paper. $500 million, gone. Sure, he's rebuilt some of it. Today, he's reportedly worth around $10 million. And yes, that's still a number many dream of. But let's get real. He could have been worth $500 million and growing. Instead, he'll never touch that peak again. And he's not alone. MC Hammer, Burt Reynolds, Lindsay Lohan, Nicolas Cage, 50 Cent, Johnny Depp. What do all these names have in common? They earned fast, they spent faster, and they never parked their money in the one place it could have been protected, appreciating income-producing assets. Instead, they kept it liquid, visible, and vulnerable. For some, seeing a fat number in their bank account feels safe. For others, it's just ignorance. But here's the truth no one tells you: cash is a leaky bucket. It slips out in pointless purchases, lifestyle inflation, and bad decisions. And if it doesn't leak out, inflation slowly erodes it, like waves grinding down a rock. You think you've got $1 million? In 10 years, that million buys you what $500K gets you today. That's not growth. That's decay. So what's the play? The only proven antidote to inflation, the only way to preserve, grow, and compound wealth is this: assets. Not expenses, not flashy purchases, not bank balances. Assets that appreciate. Assets that produce income. And in the next few minutes, I'm going to show you 7 of them. 7 places to put your money that don't just protect it, they multiply it. Because if a $400 million man can fall, what's stopping you from doing the same? Let's get into it. Asset number 1, real estate. When it comes to multiplying money, real estate is the king that never left the throne. Empires have risen and fallen, but land holds. It's not hype, it's not trend, it's history. According to Forbes, real estate is the 3rd largest wealth-building asset in the world. So why have I placed it at number 1? Because unlike the top 2, it doesn't ride on hype, markets, or luck. It rides on fundamentals. Think about it. Every adult understands real estate at some level. You buy land or property, it grows in value, you sell or rent it. Simple, tangible, predictable. Unless you're investing in a war zone or a ghost town spiraling into ruin, your chances of going horribly wrong are slim. Sure, becoming a millionaire from it may depend on how smart you play it, but just beating inflation, that's very likely. In fact, even if you never sell it, real estate can still make you money. Why? Because it's an income-producing asset. You rent it, you lease it, you build on it, it pays you month after month. It's the power of cash flow, a steady stream of money that doesn't ask for your time. But, and this is important, real estate isn't perfect. First, it's not liquid. You can't just sell it at the tap of an app like stocks or crypto. Need cash in 48 hours. Good luck selling a house that fast. Second, it's a high-ticket asset. Most real estate deals start north of $100,000. Even with loans or mortgages, it's not within everyone's reach. But don't worry. The next asset on the list, it solves both of those problems. Let's go. Asset number 2, government bonds. Keeping cash in the bank is like placing an ice cube under the sun. Slowly, it melts. Inflation is silent, but ruthless. Your $100 today might only buy $50 worth of stuff in 10 years. That's not theory. That's history. Now let's add another problem: unpredictability. Most asset classes, stocks, real estate, crypto, can grow, but they can also crash. You're always playing a game of probabilities. And then there's liquidity. Real estate is great, but you can't just sell a house on a Sunday afternoon because you want a new car. That's why so many people just sit on their cash. They're scared, and they're not wrong. But here's where government bonds come in. They're boring, and sometimes boring is brilliant. First, these bonds are usually pegged just above inflation, so your money doesn't shrink. It stays protected. That alone is a big win in a world where everything else bleeds you dry. Second, they are safe. Stock market crashes, tech bubbles bursting, banks collapsing. Governments have always paid their bonds. As long as the country you invested in doesn't vanish from the map, your money is intact. And third, they are liquid. Need the cash. Sell your bonds. You'll have your money in a couple of days. No agents, no paperwork hell. That's why government bonds are considered one of the safest assets on the planet. But nothing is perfect. Even giants stumble. The US, arguably the most powerful economy, has come dangerously close to defaulting in recent years. Why? Because of its mountain of national debt. So even bonds have risk shadows. But the bigger problem is this: returns. Government bonds barely beat inflation. So yes, your money is preserved, but it's not growing. You're not building wealth, you're just standing still. That's why I almost left it out of this list, but then I thought of Mike Tyson. If Iron Mike had parked his $400 million in government bonds and pulled out just a few million every year, he would have lived like royalty without ever touching the principal. No risk, no collapse, no bankruptcy. Government bonds are not for growth, they're for preservation. And for some people, that's exactly what they need. But what if you want more? What if you want safety and superior returns? Let's talk about the next asset, one that plays both sides of the coin. Asset number 3, gold and precious metals. If there's one asset that's traveled through time, kingdoms, empires, wars, and recessions, it's gold. Gold doesn't care who's president. It doesn't care what the interest rates are. It has seen civilizations rise and fall, and yet it still shines. Why? Because gold works on one simple principle: scarcity. You can't print gold. You can't manufacture silver in a government office. You have to dig through the earth to find it. And even then, it's rare. Compare that to paper money. Once upon a time, the money in your bank was a promise backed by real value. Now, it's just paper backed by more paper. The more money governments print, the less your savings are worth. That's inflation in a nutshell. More supply, less value. But gold stands untouched, untainted. It's the original store of value. I don't know who decided that this shiny yellow metal should represent wealth, but for thousands of years, we've all agreed that it's valuable. And as long as humans keep agreeing, gold will never be worthless. Now here's what's interesting. Over the long term, gold has given returns similar to real estate. While real estate averages around 9 to 11% a year, gold clocks in at about 8 to 10%. Not bad for a piece of metal that just sits. But unlike property, gold has 2 big advantages. 1, portability. You can't pack a house in a suitcase, but you can take gold across borders, legally with some restrictions, but still, if your life ever needs a reset in a new country, your gold can come with you. 2, liquidity. Real estate can take months to sell. Gold, you can walk into a local store or go online and convert it to cash within hours. It's one of the most universally accepted assets on earth. And this is important, gold is not perfect. In fact, there are 2 major flaws that keep it low on my personal investment list. First, gold doesn't produce income, it doesn't pay rent, it doesn't give you dividends, it just sits in a vault, silent, still, and shining. If you want to build cash flow, gold won't help you. Second, gold doesn't grow consistently. For years, it might stay flat. Then suddenly, boom, it doubles in value. If you're not in it for the long term, gold can feel like a dead investment. You'll check prices for 5 years and see almost nothing. Then 1 year, everything changes. But if you can't wait that long, if you need regular growth, income, and predictability, gold will test your patience. That's why I keep gold in my portfolio, not to grow, but to protect. It's my shield, not my sword. But what if there was an asset that could grow fast, give regular income, and still hold serious long-term potential? Well, that asset is asset number 4, stock market. There are very few assets in the world that check all the right boxes: growth, liquidity, accessibility, passive income, and yet most people never touch it. Why? Because the moment you say stock market, people flinch. Let me explain. People are afraid of losing money. They've seen the headlines, but market crashes. Investors wiped out overnight. Recession looming. They've heard stories of friends who played the market and got burned. But you know what people don't hear? They don't hear about the quiet millionaire next door who kept investing in an index fund for 20 years and retired with more money than he could ever spend. They don't hear about the woman who never made more than $60K a year, but just by investing consistently became financially free at 45. You see, people don't realize that the stock market is not a casino, it's a machine that turns discipline, patience, and time into wealth. Yes, it can go down, yes, it can crash, but zoom out. Take a 10-year view, take a 20-year view. Here's the truth. If you invest in the right stocks or broad market funds and just stay put, you have almost always come out richer. Much richer than when you started. Compared to other asset classes, the stock market is the most accessible form of wealth building in the modern world. No need to buy land, no need for 6 figures. With just $10, you can start. It's liquid, sell in seconds. It's scalable. Grow from $500 to $5 million one step at a time. And it can even be passive, thanks to dividends and compounding. But let's not sugarcoat it. There are some fundamental issues. The stock market demands knowledge. If you want to pick individual stocks, you better know what you're doing. You need to read balance sheets, understand market cycles, analyze companies, follow news. And most people, they just don't have the time. They don't have the patience. They don't have the mindset to stay calm when the market goes red. That's why, despite all its power, most people either stay away from it or get into it blindly and lose. But here's where it gets exciting. There's a new asset class that's been quietly rising, one that gives you instant results, requires minimal understanding, and has started making everyday people seriously rich. That asset is asset number 5, Bitcoin and crypto. In the last decade, a new asset class has shaken the foundations of traditional finance, and that's crypto. Every year, a new wave of financial experts step up to call it dangerous, baseless, even compare it to tulip mania or snake oil. But let me ask you this. What exactly makes gold valuable? Both gold and Bitcoin are rare, both are limited in supply, and both have value only because we, as a society, have agreed they do. Sure, gold has some industrial uses, but let's be honest. Aluminum and iron have more real-world applications, yet they're not sitting at $2,400 an ounce. Gold is valuable because it's been valuable for centuries. Bitcoin is valuable because it has the potential to be what gold was in digital form. Now, crypto isn't just Bitcoin anymore, it's an entire universe. Ethereum, Solana, Dogecoin, and just like stocks, these are traded between people. Some are built on real tech, most are just noise. That's why crypto has such a sketchy reputation, because thousands of coins have flopped and vanished. Scams, pump and dumps, rug pulls, they've all happened. But here's the truth. Some people turned a $100 bet into a fortune. They bought in early, got lucky, rode the wave, and now everyone thinks crypto is a lottery ticket. That's the trap. If you treat crypto like a gamble, it'll eat you alive. But if you approach it like an investor, cautious, strategic, diversified, crypto can become a powerful part of your portfolio. Here's why. 1. Limited supply equal rising demand. Bitcoin is capped at 21 million coins. That's it. No printing more, no inflating the supply. Over time, scarcity drives price, just like gold. 2. Institutional adoption. The game has changed. BlackRock, Tesla, MicroStrategy. Even entire governments, from the US to Germany to Finland, have Bitcoin on their balance sheets. When institutions buy in, they don't play games. They're not flipping, they're holding. 3. Hedge against fiat currencies. The dollar, controlled by policy. The Fed prints more, inflation hits, your cash burns. Crypto is seen by many as a hedge, a financial exit door in a collapsing room. It's not perfect, it's not risk-free, but it's one of the few assets that isn't tied to any single government's whim. Now, let me be clear, I'm not saying put your life savings into crypto, but if you're not even allocating a small percentage of your portfolio to Bitcoin or top-tier cryptos, you're ignoring one of the highest performing assets of the last 10 years. And remember, dollar cost averaging. Buy a fixed amount every month, whether the price is up or down. Don't trade, don't chase, just accumulate over time. But maybe you want something more tangible, something you can see, touch, own physically, but still with the potential to multiply like crypto. Then this next asset might just be your favorite one yet. Asset number 6, collectibles. Imagine this, you're sitting on your childhood Pokemon card collection. You bought the entire thing with pocket money. Fast forward 2 decades. Someone offers you $1 million for one card. Sounds insane, right? But that's exactly how collectibles work. An old Shelby Mustang, a Rolex Daytona from the 60s, a rare Picasso sketch, a misprinted $1 bill, even a first edition Spider-Man comic. In the world of collectibles, perceived value often beats intrinsic value. It's the one asset class where nostalgia, rarity, and story decide the price. This isn't your average investment. Collectibles are a playground of the ultra-wealthy. Art auctions, vintage car expos, private watch collectors. That's an entirely different world, where a single item can change your net worth overnight. But let's be real, there's a reason why this asset class is at the bottom of most portfolios. Because no one really knows why something becomes valuable. Everyone talks about limited edition, mint condition, one of a kind. But who's verifying it? What stops a company from making 1,000 more of those limited units? Technically, nothing. The entire market operates on trust and perception. And when perception shifts, value disappears fast. We saw it during the tariff wars and economic downturns. Luxury brands that were once untouchable suddenly slashed prices. Collectors panicked. Valuations dropped because the foundation was never tangible. It was emotional. And let's not even talk about liquidity. Try selling a $300,000 watch in 24 hours without losing 20% of its value. Good luck. Collectibles are powerful, yes, but they're slow, risky, and extremely subjective. So while collectibles can be a jackpot for a lucky few, they are not the asset class that will consistently build your wealth. But now, let's talk about the most powerful asset you'll ever own, one that beats real estate, stocks, crypto, and collectibles, all at once. It's the only thing that's 100% in your control, one that can compound faster than any chart. That turns side hustles into empires and ordinary people into millionaires. I'm talking about asset number 7, owning a business. Most of the wealth in the world is not created by investing. It's created by building. The biggest wealth engine humanity has ever seen. is business. Because true wealth isn't just about buying value, it's about creating it. And the single most powerful tool for creating value is owning your own business. Every other asset we've talked about, real estate, stocks, bonds, even crypto, has one thing in common. After you invest, you're just hoping it grows. But with your own business, you're not hoping. You're deciding. You decide how fast it scales, you decide who it serves, you decide how big it gets. There is no cap on how much wealth you can create. No ceiling, no gatekeeper. Jeff Bezos built Amazon out of a garage. Elon Musk turned an online bank into SpaceX and Tesla. Mark Zuckerberg wrote Facebook in his dorm room. And today, they don't just own companies. They own wealth ecosystems that print money every second because they invested in themselves first. They used their time, their skills, their vision, and built something the world couldn't ignore. The beauty of starting your own business is this. You can start from nothing. You don't need $1 million. You don't need an Ivy League degree. You don't even need to know everything up front. You just need one thing, the will to create. Yes, it's not easy. It takes grit. It takes failure. It takes years of working when no one's watching. But it also gives you something no other asset can, ownership of your destiny. So if there's even a tiny spark inside you, if you've got an idea, a skill, or a drive to solve problems, don't sleep on it. Invest in yourself. Start small, but start, because one day the world might call it luck, but you'll know it was the smartest investment you ever made. And speaking of investments, have you ever wondered what would happen if everyone in the world suddenly became rich overnight? The truth might surprise you. Watch this.